If you own a whole life insurance policy or you're thinking about starting a new one, but you feel confused about the cash value, this video is for you. You might have heard two completely opposite messages. One being, whole life insurance is the worst place you can put money. Just buy term and invest the rest. And the second, banks, corporations, and ultra wealthy families put millions, if not billions of dollars into cash value life insurance. So how can both be true? In the next few minutes, I'll show you in very simple terms what cash value actually is, why opinions are so polarized, and how to think about it so you can decide if it's a fit for your situation. So the big reason why there's so much fighting online about this is that people are often looking at different types of whole life insurance policies, but they're acting like they're all the same type of policy. So to give you a quick example, here are two types of whole life insurance policies that are from the exact same insurance company. So we'll start with what we've got on the left, which is a traditional whole life insurance policy. And what that means is we're just buying life insurance. So this is for a 35-year-old individual. He is paying $20,000 per year, and he has a life insurance benefit of $1.35 million. Now look at that cash value in the first year, zero. He pays into this for 15 years. So he's paid in $300,000 and he has $334,000. That's not that much of a gain 15 years into it. Now, if we compare that with the next example, it's a whole life insurance policy with the exact same insurance company and the exact same out-of-pocket to him. He's paying $20K per year. The death benefit is a little bit less, just over $1 million, but check that cash value out. Instead of zero, he's got about 17.5. And if you look at year 15, where he's paid $300K into the policy, he is well over $400,000 in cash value. So what's interesting about this is you've got the exact same company and the exact same out-of-pocket to this 35-year-old individual, but one option has a lot more in cash value. And this mainly has to do with the design of the policy, as you can set up a policy to be cash rich instead of insurance rich. But we'll look at more of this in a little bit. Let's talk about what cash value actually is. So inside of a whole life insurance policy, you have the following. First, a death benefit. This is the amount that is paid out when you die, and it's paid to your beneficiaries 100% income tax free. Next, you've got the cash value. This is what everyone is always interested in. This is a living benefit that you can see on a statement and also on your online account. And this grows over time, and you always have access to it while you're alive. Think of the cash value like a side account inside of the policy. Every single year, it grows with guarantees and dividends. It never goes backwards if there's a market crash or down economy. And it's really what people use whenever you hear about people borrowing against their policies or using their policy like their own bank. Now, when you look at the cash value, there are what I like to call the core benefits. When you hear of banks, corporations, and wealthy families putting a ton of money into a cash value life insurance policy, they're often doing it for the cash value, and they're doing it for the core benefit. The core benefits are safety, liquidity, the tax advantages, and that your money is always compounding. Let's hit one at a time. So starting with the safety, the cash value inside of your life insurance policy is not invested in or tied to the stock market at all. What drives the cash value growth is one, a guaranteed interest rate. This is the minimum floor that your policy will receive no matter what, even if the company does horrible in terms of performance during any given year, you still get the guaranteed rate. You'll see that range between 2 and 4.5%, depending on the company and product you select. However, most companies will pay a total dividend rate. So the dividend always includes the guaranteed interest rate, and you'll find that dividend rates for 2026 range from 5.5 to about 6.4% with the top mutual companies in the US. Now, a very important note is that the dividend rate is a gross rate, meaning you will not see your cash value grow by whatever that advertised dividend rate is. I'll give you a quick example. So here's a policy with Mass Mutual, and their 2026 dividend rate is 6.60%. If we look at this policy in the first year, what do we see? Well, you see $100,000 is paid. The cash value is $92,000. The dividend rate is 6.60%, but if you pay 100 grand and you have $92,000, I don't care if the dividend rate is 1,000%, you lost money. That's why in the annual yield column, I see a negative 8% return. And the internal rate of return will be the same as the annual yield in year one. The IRR is really the long-term average growth rate of a policy. As time passes, the policy gets stronger and stronger when we look at the annual yield and the internal rate of return. But let's look at it near its peak at the bottom of this illustration at year 20. So at this point in time, we're no longer paying anything into the policy, but we still are receiving the dividend rate of 6.60%. So from year 19 to year 20, your cash value grew from about $2,060,000 to $2,180,000. If you crunch that in a calculator, that's not 6.6%. It's less. The annual yield, which is just your yearly rate of return, is a little bit less than 5.8% that year. And if we look at the internal rate of return, which again is your long-term average, it's just north of 5%. So while the cash value grows extremely safely as time passes, it's very important to always ask to see the net returns, because the dividend is a gross rate that again is shown before any insurance expenses are accounted for. If you want to see the yearly growth rate, I would ask for the annual yield. And if you want to see the average over time, I would ask for the internal rate of return. But the first core benefit, again, is the safety. Quick pause while we're on this. If you want to see a real example of the kind of policy I'm talking about, not just theory, we put together a free case study for you. It shows exactly how someone funding a whole life insurance policy built their cash value up year by year, how much they had on day one, how fast they broke even, and how they're using their policy today. You can download it using the link below this video. And if you'd like to see the numbers based on your funding level and situation, there's a short form on that page where you can request a custom illustration. All right, let's get back into it. Let's move on to number 2, liquidity. So you can access the cash value of a life insurance policy anytime. It can be as early as 10 business days after you start a policy, so very, very soon. And there's no penalties as long as it's a whole life insurance policy. If you're looking at a universal life type product, then you could see penalties, as you'll see what is called a surrender penalty. But with whole life, you don't have to deal with that. Now, if you did want to access your money, you typically get your funds in 2 to 3 business days, and most companies will send your money via direct deposit, which is nice. And you can access your money anytime through a loan, and as time passes, you can also take out withdrawals. Now, withdrawals usually make the most sense during retirement, and you usually don't want to take one earlier than policy year 8, because if you do it during the first 7 years, you can run into a MEC, which is a taxable event with a life insurance policy. But aside from that, it is very, very easy to access the cash value in a whole life insurance policy. Okay, number 3. This is what everyone is interested in. It's tax-free if we follow IRS rules, which is very important. So how the taxes work with a life insurance policy is, first, money that you pay in goes in with after-tax dollars, just like how it works with a Roth account. Meaning if you make a contribution to a Roth IRA, you cannot deduct or write off those contributions. Now, the growth of the cash value in a life insurance policy is tax deferred, meaning as it's growing, you're not paying any taxes on that growth. However, you can access it 100% tax-free as long as we do not trigger a taxable event, meaning we're following IRS rules. If someone said that to me, my question would be, well, Steve, what triggers a taxable event? Here's three things that can result in you having to pay taxes on the cash value. First is if your policy becomes what is called a modified endowment contract, or a MEC. In that case, the cash value will still grow tax deferred, but if you ever access your cash value, you have to pay ordinary income tax on the gains and a potential 10% penalty tax if you're under the age of 59 and a half. Another way that you can potentially deal with taxes is if you cash the policy out and there's a gain on it, or if the policy lapses with a gain on it. And this can happen if I've taken a maximum loan out and I don't pay the interest and I don't pay the premium, something extreme. It's very rare, but a lapse could occur. And if there's a gain, I will have to deal with taxes on the gains. And by the way, if a policy lapses with a big loan balance on it, any unpaid loan interest can also count as taxable income. So it's always beneficial to be aware of that. But as long as we follow IRS rules and we do everything right, we can access it tax-free, which is very, very easy to do. And then point number 4, always compounding. So this specifically has to do with policy loans, and I'll give you a quick example of how this works. So let's pretend you've got cash value of 100 grand and the net yearly return is 5%, my annual yield. That means I would see my cash value grow by $5,000 this year. Now, I can take a policy loan, let's say in this example of $50,000, and the loan interest rate might also be 5%. They range between 5 and 6% depending on the insurance company I select. But if it's 5% of $50,000 is $2,500. Here's the key on this, and this is how the compounding works. I still earn 5% on the full $100,000 even when I borrow that 50K. Meaning, if I've got 100 grand in my bank account and that's earning 5%, but I pull 50K out, well, now I'm only going to earn 5% on the 50K that's left over. Whereas with this, the money keeps on compounding, even though I take some of my money and put it to use. So a question that comes up sometimes with this is, how does the insurance company do this? Well, one, they are charging you interest on the loan. So that does help offset the fact that they're giving you interest on the entire amount of money. Remember, in the early years, you're taking a loss. They're making money there. And then here's the big thing. When you borrow against your policy, they do collateralize your death benefit dollar for dollar. So I'll give you a quick example. So here we've got someone funding a policy with a total of $500,000 over 5 years, 100K per year. So this is what it looks like if I just park it and let it sit and grow. This is important to look at because we're going to reference this when we see what the policy looks like when we borrow and repay. Now, before we look at the loan example, I do want to highlight this column, which shows what your cash value is growing by year over year net. This is everything, dividends, guaranteed interest. This is what the insurance company is giving you every year. Okay, so we're going to take a policy loan in this example of $300,000. The first question I would ask is, how does that impact my values? Well, I'll see that my cash value drops by about 300K. That's my line of credit that determines how much I can borrow. And my death benefit drops by exactly $300,000. So going back to, how does the insurance company still pay me interest on everything? Well, when I take that loan, they are collateralizing my death benefit by the exact amount that I borrow from this policy. They can pay back loans however you want. In this example, we pay it back pretty aggressively, but here's what I want to highlight. If we look at the bottom of the chart, your cash value is $788. Your death benefit is back to $1.8 million. If you compare that with the example where you just let it sit and grow, what do you notice? Yeah, everything's fully restored to exactly what it would have been as if I never touched it in the first place. I received that constant compounding. When people ask, how does this work? Well, you're always getting interest from the insurance company, even when you borrow against it. So if you're a numbers person, what you can do is look at what the insurance company is paying you, what you're paying them in loan interest. And then if you want to see if you are net positive or negative, we don't want to be negative, you can look at the spread. which is just the difference between the two. But the key here is that your money is always compounding for you constantly. So what a lot of people do with these policies is they'll often put the money here, one, because it grows at a faster rate than what they're getting in the bank. It's tax-free as long as we follow IRS rules. But then they'll also leverage that money and use the funds for their business, real estate, or another opportunity they have. This way, their money stays at work for them, which is really nice. With all of that said, sounds good, but people still get burned with cash value life insurance. Typically, I'll see people get burned when it comes down to these two things. First, bad policy design. What that means is too much of your money is going toward the base premium. Like that first example we looked at where the guy had zero in cash value in the first year. The second way is by ignoring the rules. If I trigger a modified endowment contract or a MEC, well, now I've got to deal with taxes. With that said, you have to pretty much just ignore everyone for that to happen. Because if someone triggers a MEC with a life insurance policy, you're notified right away, so is your agent, and you've got 30 days to reverse it. And all you got to do is email your agent saying, this was an accident, I don't want a MEC. They forward that email to the insurance company, and the company refunds you the amount that you paid over your MEC limit. Like, that's it. So for a MEC to occur, you really have to neglect everything and just say, I'm not going to listen to my agent anymore. But anyway, if your main goal is cash value, what you want is a policy where a very small portion of your total payment is going toward the base premium. A large portion of your payment is going toward your PUA rider, which builds cash value immediately. And the MEC limit is set at a dollar amount where we're not going to be capped, meaning I don't have to tell you, hey, you want to put in 100 grand, but your MEC limit's only 50K, therefore you can't do it. So that is very important to design up front, but it's very easy to do that with all of our clients. That's something we spend a lot of time coaching them through. So if you already own a policy and you're wondering, is my policy actually designed the way that's being described here? Or you're considering starting a new policy and you don't want to guess off of a brochure, that's exactly what we help people with every single day. So we can look at your existing illustrations or design a new policy for you, and we'll show you in numbers how your cash value behaves over time. We'll go over what the guarantees look like, the non-guaranteed values, what the tax rules are, specifically what's your MEC limit, and make sure that that policy is set up to have as much cash value as possible and that you can also use it as the years pass. If you're interested in seeing that for yourself, there's a link in the description below where you can request a custom analysis and you can speak with our team. As always, I hope this helps. Thanks so much for watching. So if this was helpful and you'd like to go deeper, here's what I would do next. Step 1, download the free case study using the link below. It'll make everything we talk about feel more concrete because you'll see actual numbers on paper. And step 2, if you're serious about a high cash value life insurance policy for yourself, whether it's for your business, real estate, or you're just looking at a safe place to save money with tax benefits, I'd use the calendar link on that page to book a custom policy design session. On that call, we'll ask a few simple questions about your situation. We'll go over an illustration with you on the spot, and we'll walk through the year-by-year numbers so you can decide if it makes sense for you. No pressure, just math and options. And if you just want to keep learning for now, feel free to subscribe and check out the other case studies on the channel. As always, I hope this helps.